Good morning and welcome to Business Today. I am Umar Kaltungo. Now let's go straight to the business. The managing director of the National Economic Reconstruction Fund, Mr. Ezekiel Hussaini, has said the fund was unable to pay staff salaries while majority of the staff had been laid off owing to the 17.5 billion naira owed it by recalcitrant debtors. He has therefore appealed to the Economic and Financial Crimes Commission, that is EFCC, to help. According to him, 8% of the total customers who borrowed money account for over 81% of total non-performing loans. Speaking during a courtesy visit to the EFCC in Abuja, Hussaini said since he assumed office in August last year, he had engaged with 135 customers who borrowed between 1 million naira to 5 million naira and had been making efforts to repay. But the challenge, according to him, lied with the big debtors who owed between 50 million naira and above and have sworn not to pay back simply because it was public funds. Others said it was only their own share of the national cake. Can you believe this? Now, majority of the loans lacked requisite collaterals and were merely backed by guarantees from past political office holders. This is very unfortunate. But some of the big debtors were said to have resorted to endless litigation to frustrate the recovery efforts. He said the situation has rendered the fund broke and currently unable to pay staff salaries, while many had recently been sacked, with more to follow if nothing was done to arrest the situation. Hussaini therefore asked the EFCC to set up a special task force in NAFOND to help in the investigation and recovery of 14.2 billion naira owed by the so-called big debtors. Now, responding, Chief of Staff to the acting EFCC Chairman, Mr. Ola Olukoye, on behalf of his boss, Ibrahim Magu, assured the NAFOND of maximum cooperation, adding that the request was within its area of jurisdiction. He further assured the NAFOND boss that the Commission will be ready to assist in the recovery after a memorandum of understanding is signed to that effect. NAFOND was set up to provide needed medium to long-term financing to viable small and medium-scale production enterprises. Now, the grand objectives are to increase the quantum of goods and services available for local consumption and export, provide needed employment, expand the production base, and add value to the economy. The NAFOND has been very successful in reorientating the nation towards production culture from the old trading culture. So far, the NAFOND has approved loans for 1,497 projects valued at over 5 billion naira. All right, the pressure by the government and other investors on the pension fund administrators to invest the growing pension fund in infrastructure to cushion the effect of recession on the economy seems to be paying off, as the operators have steadily increased the value of the fund in infrastructure bond. In May 2015, for instance, the operators invested a sum of 568 million naira in infrastructure for the first time. Now, they increased it to 1.35 billion naira at the end of December 2015, but by September 2016, they had invested well over 1.8 billion naira in infrastructure bond out of the total assets that currently stand at 6.2 trillion naira. The assets under the contributory pension scheme have been recording a stable growth despite the recession. Now, some operators who spoke to journalists said they were ready to increase the level of investment in infrastructure during the current recession in the economy if the portfolios made available to them could meet the specifications of the pension regulatory guidelines. Now, it was gathered that investors who could not access the fund due to the stringent measures introduced in the investment guidelines by the National Pension Commission had been seeking the federal government's backing to get the pension operators to invest part of the funds in their projects. According to the operators, the fund is safer for investment if fully backed by the federal government securities, and the fund is not lying idle but has been invested in different portfolios, which are the federal government bonds, treasury bills, domestic ordinary shares, local money market securities, corporate debt securities, real estate properties, state government securities, foreign domestic shares and cash and other assets. Now, the fund is also being invested in private equity fund or open and closed-end fund and supranational bonds. The chairman of Pension Fund Operators Association of Nigeria, Mr. Egwirede Longe, said the pension was making notable societal impact. He noted that there had been calls by stakeholders in the public and private sectors that the fund should be used to address the infrastructural gap in the country. He explained that the draft investment guidelines, which specify to the operators how to invest the fund, led to a cut in the requirements on how much pension fund might be invested in specialized instruments such as infrastructure and private equity securities within the country. Now, Longe said that the pension fund was being optimally invested and professionally managed by the PFAs. Longe added that the PFAs could be more adventurous in the asset classes they reviewed, developed, and invested in, adding that the contributory pension scheme provided a positive opportunity over the long haul to improve the general wealth environment of the country. PENCOM, however, noted that the challenges of pension fund investment in infrastructure included availability of products and dearth of alternative asset products in the Nigerian financial markets. It also includes liquidity risks, as pension funds prefer low or no risk products that are able to generate steady income from the onset. The Director General of PENCOM, Mrs. Chinelo Onohu Amozu, stated that there was a need for the government to provide adequate guarantees to secure investment of the pension fund in infrastructure. She said while the Commission was not opposed to the idea of deploying the pension fund in infrastructure, adequate mechanism must be put in place to ensure its safety. Yes, its safety. Now, the federal government has set aside the sum of 51 billion naira in this year's budget to promote the development of the garment and textile industry in the country. The allocation is part of measures aimed at boosting the sector in a manner that will create jobs, support the diversification efforts of the federal government, and increase the patronage of made in Nigerian apparels. Statistics from the Ministry of Industry, Trade and Investment revealed that between 1980 and 2016, about 145 companies operating in the textile sector had shut down owing to the harsh economic climate. The economic challenges have made the industry, which used to be the highest employer of labor after the government in the country, to become a shadow of itself, only employing very few people. Some of the challenges facing the sector are smuggling, inadequate power supply, lack of standardization, and poor yield from cotton seeds. Now, speaking in Abuja at the opening session of a workshop organized by the Bank of Industry for operators in the sector, the Minister of State for Industry, Trade and Investment, Mrs. Aisha Abubakar, said the federal government was mindful of the importance of the sector in creating jobs and reducing poverty. She added, as part of efforts to promote the development of the sector, the federal government had decided to dedicate 3 out of the 6 special economic zones to be created this year to the textile and garment sector. The minister explained that the government was working hard to support the industry through massive investment in infrastructure, noting that this will assist in bringing down the price of cotton. The managing director of the Bank of Industry, Mr. Wahid Olagunju, said the workshop was designed to sharpen the skills of operators in the textile and garment industry. He said the bank had created a 1 billion naira fashion fund for the textile sector to be given out at single-digit interest rate of 9% and repayable between 3 to 5 years with a moratorium of 6 to 12 months. He explained that the fund was designed to provide fashion businesses an opportunity to create jobs and add value to the Nigerian economy while promoting the country's unique fashion sense. Yes, we sure do have a very unique fashion sense. All right, let's go to the financial sector, talking about debt. Nigeria is considering a new debt service provision of about 361 billion naira or $1.2 billion for the $1 billion euro bond, which was acclaimed to have been oversubscribed. Now, when consummated, the development will not only add to the country's debt stock, its current debt service provision at over 1.4 trillion naira will rise, and it will deepen the troubled debt-to-revenue ratio, which has been impeding the country's ability to freely finance growth projects. Government has said its 15-year euro bond offer was priced at 7.87% with a lump sum repayment of the principal, that is $1 billion, at the due date of February 2032. The investors had opted for a higher yield to cover their assessed risks or devaluation in early negotiations, asking for about 7.5% for a 10-year period or 8% and above for a 15-year period due to foreign exchange crisis and other macroeconomic issues. However, the aggregate cost for the deal at the offering rate may not be less than 361 billion naira at the prevailing official exchange rate, considering that investors will be paid in dollars, now representing a yearly average cost of about 24.1 billion or $79 million. But here's the thing. The net proceeds of the Eurobond will naturally be less than the amount quoted due to service charges incurred in the process. But we will be debited with $1 billion. But the finance minister, Mrs. Kemi Adeosun, said Nigeria is implementing an ambitious economic reform agenda designed to deliver long-term sustainable growth and reduce reliance on oil and gas revenues while reducing waste and improving the efficiency of government expenditure. The Director General of Debt Management Office, Dr. Abraham Nwanko, also said Nigeria is delighted to have successfully priced its third Eurobond issue, and the Eurobond is the latest step in a broader debt strategy designed to significantly rebalance the nation's debt profile towards a longer-term financing and reduce the burden of interest on the annual budget. Eurobond is the easiest platform for international fund raising for the country now because there is no string attached, unlike the International Monetary Fund and the World Bank that come with so much conditionalities. All right, we take a very short break now, and when we come back, we go still into the financial market and look at the rates at the interbank rates at considering the mop-up strategy of the Central Bank of Nigeria. But remember, you can follow this program and a whole lot of other programs on our social media platforms showing on your screen right now. Stay with us. We'll be right back.
It's broadcasting like never before as Liberty TV lands in Lagos. With our full-scale broadcasting in Hausa and English languages, residents of the megacity can enjoy up-to-date news, interactive programs, politics, business news, exciting sports, entertainment, and much more. Connect with us on GoTV channel 110, on StarTimes channel 180, and on Free TV channel 775. For your advert placement and sponsorship, please call 080-342-44414 or 081-800-30085. Visit our office at 15B Awolowo Road, Ikoyi, Lagos. Liberty TV, voice for all, vision for all.
Thank you for being there. Now, rates at the interbank market are expected to spike this week as liquidity is mopped from the financial system through bond and treasury bill sales by both the Debt Management Office and the Central Bank of Nigeria. A total of 252.43 billion naira is expected to be mopped from the system as the CBN auctions treasury bills worth about 142.43 billion naira and the DMO raises 110 billion naira through bond sales. Now, market operators say they project that money market rates will the trend northward as the demand for primary market instruments expected to be auctioned by the CBN and DMO weigh on financial system liquidity. Last week, activities at the treasury bills market were mixed as investors sold off on shorter dated treasury bills instruments. Consequently, average yields trended higher on 3 out of 5 sessions. The impact of the debit for the penultimate Friday's open market operation auctions weighed on system liquidity at the beginning of last week, leading to a 25 basis points increase in average yield as investors sold off, particularly in the Treasury bills instruments maturing in February and March 2017. Now, buying interests, however, returned to the market last Wednesday and Thursday before the trend was reversed on Friday, eventually closing at the week at 16.1%, up 83 basis points rise week on week. It is believed that investors may be liquidating their positions in anticipatory Treasury bills primary market auctions. Now, DMO said it plans to raise 45 billion naira each through the 5-year 14.5% July 2021 bond and the 20-year 12.4% March 2036 bonds. It will also auction the 10-year 12.5% January 2026 to raise 20 billion naira. Meanwhile, having maintained a rising trend in the past 11 months, an inflation figure for January is expected to rise further to between 18.6% and 18.7% from 18.55% in December 2016, largely due to a relatively lower base despite projected slower month-on-month change to 1% from 1.1% in December 2016 as the impact of Yuletide season on prices wears off. Now, if all variables remain unchanged, analysts project that headline inflation will begin to ease from February 2017 due to high base in the corresponding period. Although prices may edge higher if the naira further depreciates as the feedback effect on energy, that is petrol and diesel, prices may fuel further hike in general price increase. Talking about hikes, more and more hikes. Now, the National Bureau of Statistics said that out of 331.02 billion naira worth of invoices issued by the power generating or generation companies to the electricity distribution firms last year, only 88.03 billion was settled. The MBS, in a report on the power sector, put the outstanding balance that the distribution firms owed the generation companies at 242.97 billion naira. The Nigerian bulk electricity invoices and payment from the generating companies to the distribution companies and off-takers for 2016 have reflected that an invoice of 30.51 billion naira was issued by the generating companies to the off-takers, while a payment of 2 billion naira and a debit note of 1.12 billion naira for net generating companies imports were made, with a balance of 27.3 billion naira recorded at the end of 2016. The generating companies issued a total invoice of 331 billion naira to the distribution companies, with a discourse share of the total invoice put at that same figure, while payment of about over 88 billion naira was received, with a balance of 242.9 billion naira recorded at the end of period under review. Now, a breakdown showed that 88 billion naira payment was received by the generation firm. Those AFAM, that is the AFAM generating company, paid 3.6 billion, while Alaoju paid 3.2 billion, Calabar paid 1.6 billion, Delta paid 9.6 billion, Egbin Power Plant paid 16 billion, yes. Bahrain paid 539 million, Geregu was 2.7 billion, and of course, Geregu National Integrated Power Project also paid 2.3 billion naira. All right, lastly, let's look at the issue of the foreign reserves now. The steady growth of Nigeria's foreign reserves has been attributed to the main reason the country's Eurobond issue was oversubscribed by 780% last week. The Godwin Emefiele-led administration's determination to boost the country's reserves is increasing investors' confidence in the Nigerian market. Now, following the Eurobond issue, Nigeria's foreign reserves climbed to $30.5 billion from $29.5 billion. The CBN also plans to increase reserves to $35 billion by the middle of this year and $40 billion by the end of the third quarter. Now, here's the thing. With a comfortable level of forex reserves, foreign investors will be assured that once they want to take their funds out, they can do so without hindrances. Now, once reserves fell to as low as $21 billion, investors were not attracted to the Nigerian market, irrespective of whether we devalued or whatever we did with the forex market. Now, as long as they felt that you had insufficient reserves to meet your foreign obligations, they were not going to remain comfortable about investing in the Nigerian economy. They continued to exit the economy. If you look at an example of South Africa and Kenya, which have floating exchange rates as well as that of Nigeria, yet they have found it difficult to attract investors. They continue to flee their economies in droves. However, since the International Monetary Fund announced in, was it November? Yes, November last year, that it had approved a $12 billion standby facility for Egypt, the country has been attracting almost $300 million every month. Now, what this means is that investors need to feel comfortable with your level of forex reserves and your ability to meet your obligations when they fell due. So instead of the central bank getting distracted by the debate over devaluation or no devaluation, it has focused on reserves accretion, which has helped to attract investors during the Eurobond sale last week. Well, I guess that about rounds up the program for the day, but we now leave you with the graphics of activities on the floor of the Nigerian Stock Exchange at the close of business yesterday, and of course prices of commodities in some Nigerian markets, and then yes, the volatile forex market, which is at about 506 naira to the dollar at the parallel market. Not the interbank has remained kind of steady at around between 300 and 315, but at the parallel market, or black market as we used to call it down here, is about 506 naira to the dollar. Amazing, isn't it? Very many thanks indeed for watching. I am Umar Kaltungo. Good morning.